Okay, Tom Lee is back. Tom Lee sees the markets rallying. Tom Lee has been known as someone who is a Wall Street analyst. People call him a perma bull. Look, he's very bullish, but the CPI print that just came out makes him even more bullish. And today, we're going to be reacting to Tom Bull, thinking that the markets can sustain a rally that's even above what we had right now at 4,000. A little bit more into the 4,400 range. Let's see what Tom Lee has to say, and we'll go from there as we analyze it.
Let's ask Tom Lee. He is Fundstrat's head of research. He's here with me on set. He's also, of course, a CNBC contributor. It's great to have you here. Thanks for coming in.
Great to see you, Scott.
You did call yesterday's CPI a quote-unquote game changer. Why?
I think it was the first time that the market could see an improvement in some of the underlying drivers of inflation, from shelter cooling to the durable goods cooling, medical, which was really on fire, flipping. And it means it's repeatable. You know, the Fed wants to see a series of lower inflation prints, and I think we're set up for the next few months of 0.2 to 0.3 month over month. That's 3.5% inflation.
You said the key.
So that's the first thing that Tom Lee thinks. He says, look, the Fed wants to see repeatable types of inflation decreases. And the things that he mentioned, things like Medicare, things medicine or shelter, these were categories of inflation where he feels are going to repeat. They are scalable, one could say in a sense, or descalable because we're going the opposite way, and that they could actually go down, that the cost could go down, that the levels at which they were at are obviously not going to be at the levels as they were in January 2021, and that if that is the case, we went from 8.3 or 8.2 to 7.7, which is pretty significant. If we can go down to 7.3 and then 7.1 and then 6.9 and then 6.4, I mean, that level of reduction will force the Fed to think about deflation. I know Kathy Wood is screaming that deflation is going to come, but the Fed is going to have to think a lot more deeply about deflation if that's the case. And that would lead to a lowering of rates or a lowering of the pace of growth of raising interest rates, potentially a decrease altogether of raising interest rates. And if that happens, because inflation is trending downward, stocks can rally. And so Tom Lee thinks that stocks, as a result of this overarching theme that likely could happen, are going to be able to sustain the rally.
A series of lighter inflation prints. This is just one.
Correct.
It's just one.
But it does look really repeatable. Again, because medical insurance only adjusts every 12 months, it went from being roughly 2% a month to a -4. So you're going to get -4 the next 12 months. And shelter, which has been on fire as much as 0.8, is now down to 0.6, but now it's converging towards where markets are. So it's, I think it is very repeatable.
So let's get serious about this move. How far do you think it can go? How long do you think it can last?
I think that the June rally and the sort of false dawn pivot is a minimum template. That was about a 20% rally over 25 trading days. I think this one's going to be far stronger.
Wait. Stronger than 20%?
From the low. At least 25% from the 3,500. So something that could carry us to 44 or higher. And that's because...
So there we go. Tom thinks 4,400 is possible, 25% from the lows, and he's going to explain more why he thinks that's possible.
Because we have, for the first time, sort of the ingredients for the Fed to do a convincing pause, you know, to go from being a higher in a hurry to one that's more predictable, one that the markets can deal with, but possibly now raise the question that maybe the last hike is going to be December, and then the Fed's done.
Do you really believe that December is going to be the last hike for a while, that they do that and then they pause? Because their rhetoric, you know, even in the face of the report you yourself call a game changer, was still pretty hawkish.
Yes. Powell's made it very clear. He looks at forward inflation, not realized. You know, CPI is showing us what happened. If forward inflation is running at 3.5, a Fed at 4 3/4 is actually quite tight. And that, along with, we already see so many leading indicators of inflation being lower, that the Fed can move away from the hard data, see the job market cooling. Trucking is the most common job in 29 states. There's a lot of cuts in trucking coming. The labor market's softening up. I just think the case for accelerating inflation is over.
You think, I mean, look, Jeremy Siegel, the Wharton School, was with me yesterday and said inflation's basically over.
Yes.
It's kind of hard to declare that at a 7.7 print on the CPI.
Yes, the stock market in 82 bottomed when the inflation was around 7.5% on its way to 3. Volcker didn't posit pausing or ending the fight until October. So 10 weeks before the Fed actually even offered a view, the stock market had already bottomed.
Now, that was one of the most interesting elements of this. So in 1982, obviously, we were dealing with a rough decade in the 1970s with stagflation and everything that was going on. Then we got in Volcker. Things had to start changing. He was the new chair of the Fed. Inflation got up to at least, interest rates went up to almost 15-20% during that time. Now, I mean, it's an interesting historical comparison. I know it's 40 years later, things are incredibly different, but the stock market bottomed when inflation was about 7.7% back in 1982, on its way down to 3%, and it's what led to a pretty good 80. I mean, this is just an incredible idea. Now, a lot of people are thinking this is a double dip recession, where the real recession hasn't even happened yet in 2023, but if Tom Lee is correct, if Kathy Lee is correct, that inflation is on its way down, and that the historical precedent that has been set before when, inflation's on its way down to 3.75, but the Fed wants to get to 4 3/4. That is a very, very tight market that's going to create a level of stimulus that is needed in the economy for the market to go back to normal, because that you can't operate an economy in that way. And the Central Bank of the UK the other day, they had to realize they had to lower some rates because it just wasn't working. That is the bull case for the markets to go up, and we're going to see if ultimately that can happen.
You've been advocating FANG for the duration, for the most part, right?
Yeah.
Feels like those stocks are broken. No?
Yeah.
I mean, it really does. It's kind of undeniable that they look that way.
Yeah, it's been a terrible call. I think FANG still produces secular growth, but this year, a lot of inflation companies, sensitives like energy and some industrials, produce growth that's much better. And you're right, they're crowded. I think you're right. I think the market's going to question FANG for some time, but I think they should still be in people's portfolios because they're high return on equity companies. They solve inflation in the future, but that's not what people care about today.
Well, I mean, I'm thinking of, if the Fed, what do you think the Fed's going to do in December, by the way? Because, I mean, it all plays into the same conversation about these mega cap stocks and other areas of tech.
I think the futures market has it right. They're looking at 50 basis points, and unless we start to get so much cooler inflation, I would say the odds are that it's either 50 or 25, not 50 or 75.
All right, there you go. That was Tom Lee. And so the argument there was incredibly interesting. Obviously, he's very bullish on FANG. I made a video a long time ago about why Tom Lee is bullish on FANG stocks. He loves the return, the nature of the return from stocks like Apple and Google and Facebook, or Meta. But the core thing here is that he believes every stock and the entire market itself is going to rally as a result of inflation going lower. Now, the Fed deciding not to go the 75 basis points route in December and going 50 off of the CPI print is something that people think is possible, but a lot of people really think the Fed needs to be able to stomach 75 again. Now, after December 75, I think in January, if we have a consecutive CPI print where the market goes even lower and we have 75, I think we have a really nice Santa Claus rally, and it would be hilarious if the market rallies to 4,400 by the end of the year and we started at 4,800, 478. I mean, for us to start at 478 in January and for us to go through everything we've gone through in 2022, it's been a hell of a year. And for us to come back at 4,400, I mean, my goodness, what an amazing year this would be for the stock market. And what an amazing year would it be for anyone who timed the bottom around 350, 360, 370, or was able to pick up, even if they were just DCAing. Tom Lee makes a compelling argument. Obviously, he's a perma bull, so you have to take it with a grain of salt. But one of the things to remember about someone like Tom Lee is that he is a macro guy. And yes, he's got the macro wrong the past couple months because inflation came in a little bit higher than what he thought he'd even come up with. And that's what shocked the Fed. It shocked everybody in the world of the markets. But it's starting to come down. And if it doesn't come down further the way it is supposed to come over the next couple prints, and we see that the Fed is continuing to be hawkish, then none of this matters. If it does, if December's CPI is amazing, the Fed has a very difficult decision around if they want to continue to be hawkish, because you cannot continue to be hawkish if it's going down. The whole point of the Fed being hawkish was for it to go down, and the rate of it going down and the level of it coming cold or hot is going to be the variable for the Fed to be able to make the decision that's going to affect everything else in the market, including stocks and equities. So let's see if Tom Lee gets it right. Thanks so much for listening and watching. Let me know your thoughts in the comments, and I'll see you guys in the next one.